I want to start off with just some statistics. We're in a moment of dramatic change. By now, I hope everyone's heard about artificial intelligence. Without sounding too arrogant, AI, Silicon Valley is still the center of the AI universe. Not necessarily for investments, although that's actually happening, but it is on thought leadership. So according to CB Insights and PitchBook, in 2023, generative AI startups raised $22 billion. And in 2024, it's now 9 times that. It's $130 billion, with over half of that coming from Silicon Valley. So you can see the shift. But what it's also saying is globally, there's more interest in AI because the year before that, it was like 90% of the investment was coming from Silicon Valley. So as I mentioned, today's panel is definitely not specifically on AI. It's just that AI is shaping a lot of how things are happening, how things are moving. It's actually causing a lot of shifting with the data and the pattern analysis. There's a company in Silicon Valley called Carta. You might be using them for either managing your cap tables or doing secondary offerings. And from that data, you can see how the VC landscape is actually changing. So the panel today is actually having very senior people in the family office and VC space talking about how they're adapting and some of their key strategies. And so with that, I'd like to welcome each of the panelists to give an introduction. And we'll go right down the line, starting with my good friend Kingsley.
Thank you very much, Keith. Great to be here. So I'm Kingsley, chairman of Advani Family Office. We run 3 funds and we have 2 operating companies. One of the funds is Bitcoin only. We also have a crypto fund and a VC fund. We've made over 200 investments. And then on the operating company side, we took a view of, let's incubate our own companies with a view to taking them public in the next 12 to 24 months. Happy to be here, and thank you.
Thanks, Kingsley. Hale?
Hi, everyone. Hale here. I actually come from an institutional LP background. I used to work in Europe's biggest fund of fund, investing into VCs and private equity firms. So I specialize in private equity. And currently, I actually help founders raise capital, emerging fund managers get access to exclusive LPs, allocators, which is extremely difficult in this market. And we also invest especially to specific industries that we believe will build the future. This is what I do.
Thank you. Anmol?
Hey guys. My background was initially a founder. I exited when I was 19 years old, then moved into corporate, into JP Morgan, and Marsh McLennan was the youngest person at 22 to carry a $3.2 billion transaction, then moved into venture, and I currently own and operate 3 arms of investment. We have a venture studio which invests in super early stage companies, sub 6 to 7 million valuation. Then I've launched a venture fund as well. As I close that now, I'll become the youngest ever VC with an 8-figure fund in the world. And I also have a multi-family office where we allocate capital for 30 different families across Singapore to West Coast of US. So mainly looking at AI, disruptive technologies from early stage to sort of growth stage, where we try and identify where we can be strategic value adds.
And just to mention, and some of you will get this joke, Anmol's the type of guy that you never want to introduce to your Asian parents if you happen to be Asian. So, thanks, Anmol. Carlo.
It's never good to talk after this guy. So, big curriculum. So, I ask Ritosa not to put this guy next to me. So, Carlo Almeida from Portugal, chairman of some private equity companies in Brazil, Portugal, Belgium, lately UAE, Dubai. So real estate in Portugal, agriculture in Brazil, private lodging in Belgium. Last almost 4 years, I've been going to Dubai often, bringing companies, opening strategic partnerships, raising funds. At this moment, we have a pipeline of $500 million in terms of clients that want to enter the market and raising capital investment. So basically it's this.
Well, thanks everyone for the great introductions, and we'll kick it off with the first question, and I'll direct this to Hale, and we'll just go down to Anmol, Carlo, and then end with Kingsley on the first question. How can family offices better position themselves within the VC ecosystem, beyond capital, to access the best deals and fund managers?
Thanks, Keith. So first of all, I think the fundamental difference between family office money and VC money, and we see this a lot nowadays, is the horizon and the patience of that capital that comes in. I think the VC world is currently broken because obviously there's a liquidity crisis. LPs have not gotten their money back. The 2x returns are really hard to come across nowadays with fund investments. So, and founders are more and more seed strapping, and that's a practice where they raise seed capital and they never raise again. Because it's just the terms of the VC investment due to the power law in place. When there's an obligation to return capital, let's say gross capital, 3x, 4x to your LPs, that creates this dynamic where the power law makes for very founder-unfriendly terms, and that actually prevents some certain very important sectors of the world from getting funded by VCs, right? Let's think about biotech, space, robotics, infratech. So these are things that are not VC play. And this is where really family offices come in. They come in with more patient forms of capital. Obviously, there's no LPs that are breathing down their necks to return capital. So that's important for at least certain industries in the world to be funded where VCs are completely insufficient. And that's the best positioning, in my opinion, is to provide that. And the second thing is that VCs tend to say that they have amazing networks, deep expertise. That's not always true. There's a lot of generalist VCs out there. There's a lot of emerging fund managers that are trying to make it in this world. And there's nothing that comes really close to multi-generational family office network and deep expertise. There's a lot of family offices that make their wealth in certain industries, let's say manufacturing, logistics, healthcare. And that deep expertise can be very much positioned to be very founder-friendly and friendly to portfolio funds as well. And let's say that could be used to vet deals, bring operational diligence into the due diligence process. That can be used to co-invest and bring in syndicates and other family offices and private investors to build up rounds. So that's very important for fund managers. And for the founders, warm intros, getting in the first clients, getting in the first customers, and these are incredibly important things that VCs unfortunately tend to fail at. And I think that's the biggest thing. But in the end of the day, getting deal flow is never a problem, right? Getting quality deal flow is the biggest problem. Getting exclusive off-market deals is extremely difficult, unless you have a very good network of advisors, scouts, ex-Sequoia, A16Z scouts working for you. And if you don't have that as a family office, and I think it's important to be visible and also build a brand. And I know that many family offices don't do that. But if you do want access to exclusive deals, and if you are lacking that VC network or venture network, important to be visible because the rest of the value proposition is already there.
All right, thanks, Holly. Mo?
I think I would like to echo a lot of what Halle said. I think having, and just diving a bit more deeper into one of the points that was made is, I think identifying your niche. I think generalist play over a long course is pretty much done. And when we usually think about the likes of YC and your bigger generalist guys, right? Not to have anything against them, but the statistic is YC so far has invested in 2,700 companies.
5,000?
I think is about. I
Wait,
think
wait,
yeah,
wait,
yeah.
Oh, no,
Since-
5,000, yeah.
Yeah, since I think this was 2023, so I might be slightly behind. But till 2023, of that 2,700, their DPI, 50% of their DPI came from 3 companies, right? DoorDash making about 23% of them. So you're saying 99% of the companies are pretty much resulting in nothing, right? And these are multi-thousand investments. So I think as a family office, having a niche, right, where you can say whether it's prop tech, whether it's biotech or health tech or certain sort of niche where you are the key player, you know the market opportunity. And one other thing I wanted to reiterate was the best of the best founders, they don't need extra money, right? If you're the top 1% founder, which we call it, if you're raising 5 million, you probably have 10 available to you. So you're the one in the driving seat making the decision of, do I want you on board? So why should I want you on board? Well, as a family office, yes, you have capital, but so do other guys. So what doors can you open for me, right? What sort of network do you have? Can you leverage that? If I call you at 5 p.m. on a Friday, are you going to pick up, or are you going to say, speak to my PA and she'll connect something, in 2-3 weeks' time, right? So wanting to understand how actively you can be involved, having a niche and having some sort of expertise in a direct channel, I think that's a really good value add. And I think if you make that presence known enough and that strength in your network known enough, I think you'll see good opportunities. There's a lot of families here as well that we've sort of co-invested with, and there's always sort of opportunities within networks like this. So I think putting more and more of a conscious effort towards that, I think, would be great.
Thanks, Anmol.
Ali, yeah, it works. Ali and Anmol already answered almost everything, but your question was also deal flow.
Yes.
And I think this type of venues, it works a lot, having family offices, VCs, founders, entrepreneurs, meeting each other, trying to find a common path. So this is a very important.
Yeah, before we get to Kingsley, I think it is really relevant what Hale, Anmol, and Carlos said so far, that I'm an LP in a couple of funds, and they'll tell you that, reinforcing what Anmol said, it is a 98 to 99% non-success rate, like, for lack of a better term. And really, that's where it comes down traditionally to the right relationships. Our best investments have been basically, you should invest in this for this reason, and you have an opportunity. And a lot of times in Silicon Valley, you're not able to get into these investments, you're not able to get into these companies, and so it is that direct relationship that helps a lot. So thank you for your insight. Kingsley, I love and I know very well, and I think he might take this question a little bit differently, so that's why I wanted to parse out the three and then go over to Kingsley.
Sure. Yeah, I think when you're getting access to deals, I'd say you have early stage and late stage. On the early stage, so I think being part of different accelerators, so you mentioned Y Combinator, 500 startups, there's some crypto ones like BNB Chain. One of my highest return investments was Solana. I met them when they were just co-working out of a 500 startup space, and they did need the money. You mentioned the best founders don't need the money. I would argue early stage, they definitely need the money. So you want to be finding very ambitious founders on the early stage side that do need the money, but it's also the highest risk. So they could run out of money as well. So it's a bit of a stab in the dark that just pray that they'll be successful. That investment was about 1,000x return. So the early stage can really pay off. Another similar investment, Zilliqa, was about a 50x. It was through an investor group. So we all kind of crowdsourced our due diligence. We had about 150 investors in Slack. So we were vetting, hundreds of companies at a time, and we all went in on that deal. So I'd say, Hadi mentioned earlier, your network is important. I definitely agree. And even when you go to these events, you want to be asking fund managers and accelerators, which are the top companies in your batch? Which are the top companies in your fund? And I would say, you asked another question about investment horizon. In a bear market, you want to be investing because you're getting the best price. And then in the bull market, you want to be taking profit. So I'd also say that timing is very important as well. In the bear market, you can get the best deals. On the latest stage side, getting assets like Bitcoin, everyone has access to buy Bitcoin. So there's not necessarily barriers to entry there. Some of the best founders on the late stage side are super oversubscribed. So SpaceX, for instance, OpenAI, Anthropic. But you can still get good returns on the late stage. So yeah, I'd say getting access, it depends. Early stage has higher returns, but it can be harder to get access, so you need a strong network. And then late stage, you can invest in assets like Bitcoin or SpaceX pretty easily.
Thank you. Thanks, everyone. So sticking on to what Kingsley was mentioning about timing, and I'm going to go to Carlo. Do you believe timing in this market, especially with the things that are rapidly changing, do you believe timing matters? Are you sticking to your investment thesis that you've stated, or are you pivoting?
Depends. So long term, you get compounds, and it's less risky because short term, you get more opportunistic deals, but still, everything changes overnight. We just had 12 days war. Hopefully it's finished already. So better for the long run. So stick to the strategic plan and try to find your line of business that you know that at least you try to understand that 10 or 20 years it will be there. So I would go for the long run.
Okay, thanks. Anmol?
I think it depends on sort of what sort of type of company you're looking at. From an early stage company, you can never make a bet, even if it's a great opportunity, right? Because there's no liquidity in the market. So even if you do time the market, how do you get out, right? A lot of the AI plays, right? My good friend Alan that mentioned in his speech as well, these Vision 2030 companies, these companies right now might be poised for the greatest of the greatest return. You've seen an opportunity, right? But how do you exit out of it? So timing the market on the early stage is not possible. On the later stage side, definitely. One good or bad example was almost Klarna, right, which was meant to IPO earlier in the year, but that has been switched, right? So a lot of people had early access to the information that Klarna was meant to IPO in April. A couple of the family offices that I know, they invested in January, and that was meant to be a 2.5x sort of IPO in space of 4 months, right? Unfortunately, that didn't happen because of internal director politics and so on and so forth. But those kind of opportunities, where there's a quicker return at the later stage, I think are opportunistic. But if you're looking at pure venture play, you need to ask yourself, if I am switching, then why? Right? I never say switching is a bad thing, because just like founders, I think fund managers such as ourselves need to pivot and think on our feet, right? Whatever you start on day one, you're not going to end on, day 100. For example, YouTube didn't start as this, a social site. It started as a dating platform, all right? You were meant to put on a video and then meet your companion, but look at where it's now, all right? So I think fund managers need to adapt to information as well. But if it's that constantly changing, then you need to maybe reassess why you're the right fund manager and if you even are the right fund manager.
Thanks, Anmol. Ale?
Yeah, and I also don't think it's mutually exclusive. It's quite complementary. My investment thesis is that I follow founders 10 years into the future. So there is no industry that will not be impacted today in the next 5 to 10 years, right? There might be some industries that are remaining, but everything is going to get transformed. So it's impossible to predict the future. And first of all, good luck also timing the market. Just like you said, early stage VC investing, if you're invested into funds, well, then that's your investment horizon you signed up to for 7-12 years. You cannot time that market. But I think deep industry expertise is the constant alpha in this game, and I think that's where sophisticated investors generate high returns. And I think there's nothing more valuable than the information advantages of a particular sector. If you understand where value is created, where it's regulated, distributed, and monetized in a specific industry, I think that's where you generate the most amount of return. But of course, this is not to say market cycles don't matter. They definitely do matter. And I think down markets are very important. If we look at the best vintages of funds, right, we look at the 1 to 3 years after financial or crises, right? When we talk about the dot-com bubble, right, the best vintages from that decade is 2001 to 2003. That's where Facebook and LinkedIn are born, for example. After global financial crisis, the best vintages tend to be 2009, I think, to 2012, if I'm not mistaken. Airbnb, that's where Uber is born, Slack. As you invested in. And then now we're looking at 2023 to 2024 being a really good vintage for funds. We're not sure yet, right? It's too early to say, but we have a capital crunch. Access to capital is very limited. There's the financial discipline among the founders. AI is creating inordinate returns. So I think this is also an interesting time to invest into funds and direct as well. But I think it's very complementary.
Thank you. And what's interesting, Kingsley, do you have more to add to the timing?
I was just going to say, again, early stage and late stage for investment horizons. On the early stage, don't invest money that you need to eat, right? You're going to be holding that for a long time, and there's not a clear path to liquidity. One example is OpenAI. I've known Sam Altman since like 2014, 2015. And when he started OpenAI, it started as a non-profit. So it was very difficult. Even I asked to invest back then. He said, hey, we're a non-profit.
It technically still is for the time being.
So for that one, you couldn't imagine it getting to 100 billion, 160 billion from a non-profit. But again, you're investing without an idea on liquidity on the early stage. But that it doesn't mean you shouldn't invest. Like, you should still back very strong founders because they'll probably figure out a path to liquidity. On the later stage, definitely, having assets like Bitcoin, they are more liquid. So let's say you have, you have a Bitcoin position and it goes up. You can take some profits and redeploy it into earlier stage, or for general, just to take out of the market as well. So you want to have some balance of early stage and late stage.
Yeah, I think that's all very excellent points. Going back to summarizing in terms of the vintage of the VC, it's also the way it looks at right now. Again, we have all access to the data. So it's a generalization. If you were a third or fourth round fund that started before the FTX crash, you might be in a crunch right now. If you started a fund in the last 2 years, you do have a good shot, depending on what you're investing in. And so the final question is really open-ended on, because this discussion is about VCs and family offices. Where's the harmony there? Where's the relationship? Because I think like what we're talking about in Silicon Valley is that there is a solopreneur somewhere that will become the first solopreneur unicorn, billion-dollar valuation. Given with all this information, does it get a bit overwhelming, or are you able to synthesize that to effectively manage your portfolio? And I'll start with Anmol, and then we'll just go back to Carlo, Hale, and Kingsley, and we'll be done.
I think, with every challenge, there's an opportunity that presents itself. So I think with the likes of AI, for example, right, it definitely has slightly overcrowded the market, right? Everything is .ai. I think the other day I got pitched water.ai, and I was like, what the hell is that? And, something about the taste of water in a certain way being better for you. And I was like, what's that to do with AI? Right? And maybe that's the water back there. So, the space... Yeah, exactly. So I think the space definitely has gotten overcrowded, but that has also resulted in some really cool opportunities, where identifying these AI companies which can make processes shorter, faster, better, stronger. So I think we always sort of try and look at it from a optimistic but realist lens, right? There's a lot of cool guys wanting to do really cool things, but I want to encourage them, but what does the data say, right? Can we extrapolate some sort of data and analyze it in a certain way where realistically, it can make sense, right? I don't have the funds like Masa-san and put in like 500 billion into stuff, so I have to be very calculative in terms of the investments that I'm making. So I think there's definitely opportunities, and in terms of risk mitigation, luckily, I have a very strong network, Hale being one of them, where I can go and ask questions of like, this is what I'm thinking, what do you think from your lens, right? She came from the EIF background, I've been a founder, I've been on the large corporate side, so we have different viewpoints. So to mitigate that, I try and any sort of good deals, I try and bring people in. Like you said, that the best of the best deals is when people bring you in and then you go, I'm doing this because of this. Do you see the same way? And maybe they go, dude, heck no, right? And sort of try and leverage that.
Thanks, Anmol. Carlo?
So having good partners, it's very important. Hal is I think is working with some people, us included. So AI right now, everyone is looking into it, and the multiples are there if you choose the right team. I think it's more the team than the project itself. But of course, if you working or dealing with the other type of projects that would not fit on a VC strategy, that asking for 5 or 10 or 500x or whatever, you need to find other type of investors. Middle East at this moment, we just mentioned there's a lot of lack of liquidity in the market. I believe Middle East, UAE right now, that market that we're working on, there's liquidity for good projects. Also, the strategy and the investors, if you're talking about sovereign funds or private entities or family office that are waiting for the or at least are aligned for the long run, that ones we can work and bringing in projects that are not the 10x or 20 in the short term, but will work afterwards.
Thanks, Carlo. We'll go Hale and then Kingsley. We'll finish with you.
Yeah, I mean, you mentioned an interesting point, and I wanted to mention this too. $1 billion companies who are one or two founders, and that's it, right? And that kind of situation doesn't leave any room for VCs, right? So, and I think that we are in a transition phase where VCs absolutely need to reinvent themselves to be relevant, because again, more seed strapping, more at least the performance of the companies, the growth trajectory is heightened by AI and AI applications. So I think different hybrid models of VC investments are something that I would be interested in, because currently the blind pool investing into an entity that will give you maybe 2x returns, maybe in 12 years, I think this is really on the decline. There is a way that funds will always be relevant, though, and I think, for example, I'm extremely bullish on biotech for the future, at least in the next 5-10 years. I think humanity will maximize upon the technologies that come from biotech, for example, especially gene editing, gene therapy, neurotech, longevity. These are things that I'm really interested in, drug discovery as well, space, energy, security. These are very interesting fields that I think will build the future. But in order to get into those, I don't have the expertise. I would need to pay experts, and I do have biotech investments, but it's through syndications or people who understand the field. So in the sectors that you don't have any expertise on, that's not a good sophisticated investment strategy if you're investing into something you don't understand. The best way could be to invest in a friendly GP that you can trust and that they have good historical returns to take you to the sectors. And or markets that you don't know, right? Like, for example, India, right? Anmol invests in Indian founders. I'm extremely bullish also on India. Amazing fintech, amazing health tech solutions coming out of India. Have no idea what to do in India and where to look for deal flow. And that's when I would invest in Anmol, for example.
Well, thanks,
You didn't
Hale.
pay me for this, but yeah, that's where I think funds are relevant.
We'll
Right?
go to Kingsley.
Yeah.
Go ahead, Kingsley.
Yeah, I'd say one of the best ways to understand. I'd say one of the best ways to understand your investments is to start building and incubating your own companies, because with AI you can really have less people to have a big impact. So previously when I'd invest, I wouldn't pay as much attention to headcount. So if the founder was over hiring, I wouldn't really tell them to stop hiring. But now, after you've built a few companies and you know what it takes to take a company public, you get a better idea of, are you investing in, is the founder doing the right thing or not? Because otherwise you're just speculating. One example is some companies I invested in before, I kept asking, when are you going public? When can you list with exchanges? But if I didn't understand the process to list with exchanges, I can't really get an idea if they're just being lazy or too slow, or if they're doing everything they can. So I'd say with AI, I would recommend for family offices and VC funds starting to build your own companies, because you can really understand what it takes to go public.
All right. Well, thanks again, everyone, for the opening keynote panel. What I'll say, having also, like Gordon, been coming to this series for over 4 years, that when we say that you look through the programs for those who've come over and over again, we see the titles, we see that the panels have similar themes. But I'm telling you, for the current time until the next 18 months for sure, things are going to be changing very rapidly. And so even as we host these panels, we get new ideas and insight. I think the game is changing. I think the messaging with how we actually look at deals, collaborate on deals, is shifting, and so we want to stay on top of it. So thanks again for Carlo, Anmol, Kingsley, and Hale, and we'll bring Gordon back up.